We got the first big inflation report for the week. It is Wednesday, June the 10th, and this is Markets with Megan. If you like this podcast, you can subscribe to it. There's an alarm bell you can hit. Also, share it with your friends, family, colleagues, anybody who wants to dig into some of that economic data we get, especially when it comes to the headlines that you read and what really is the underlying story here. And let's start this with what we got today. It was the May reading on the Consumer Price Index. So this tends to be very market moving event. We are seeing equities significantly weaker today. It's not all the inflation reports. Some of it has to do with increasing geopolitical tensions with Iran, as well as some profit taking ahead of the big SpaceX IPO that we'll receive later this week. But let's dig into these details. What we got and what you'll see from the headlines is that inflation's not that bad. It actually came in as expected. Well, you can't say it's not that bad when it comes in as expected, but the as expected number is very high. So when you look at the headline level, this takes into consideration all of the energy prices that we've seen. Energy's up 24% on a year-over-year basis. Gasoline's up 40%, and fuel oil is up 59%. So that pushed the headline level to 4.2%. That's the highest we've seen since April of 2023. And the core level, that is rising 2.9%, higher than it was last month when it was 2.8, and that's the highest since September of last year. So both of these are going in the opposite direction of the Fed's preferred inflation target, which is around 2%. When you look at the service sector, this is where we spend the majority of our money and where consumers are getting squeezed, and these can be sticky. When you look at service prices on a year-over-year basis, they're rising 3.5%. And when you take out that volatile energy component, that's rising 3.4%, which is also the highest since September of 25. The core reading, when you just look at the 3-month moving average of that year-over-year level, it's ticking higher on a year-over-year basis. It's now 2.7%. So again, going in the wrong direction. Some of the details in this, there was some surprise that the food increase was muted. It was only up 0.2. But if you look at some of those things within that food component, so fruit and vegetables are up 6.1% on a year-over-year basis. Food just generally at home is up 2.7%, a little bit better than last month, but still 2.7%. This is stripping the buying power. And what we saw was real weekly and hourly earnings in negative territory again for the month. Some of the other details, airline fares, this has everything to do with gasoline. They're up 26.7% on a year-over-year basis. And then apparel is something we've talked about as well because we do import a lot of those goods. That's up 4.8%. So this might not have been as bad as maybe the worst case scenario had expected, but when you are seeing inflation rising 4% at the headline level, 2.9% at the core level, it is outpacing the gains in wages. This should be concerning for the Fed, and the new Fed chairman comes in next week, so we'll get some more kind of appetite on how long he wants to leave this running hot. Does he think that this is just a supply shock that will be over once this war is over? And unfortunately, it looks like that's intensifying again. That's all that we have today. We'll be back with the producer price index, which comes out tomorrow. And then we also have consumer sentiment towards the end of the week. If you want a history of our podcast, you go to marketswithmegan.fm. Thank you.